Let's start with something simple. Why do most people fail in markets? It is not because they don't have a strategy, and it is not because they don't understand charts. It's because they don't survive long enough. And if you look at the first idea from the presentation, everything starts with one principle: survive first. You cannot control what the market does, and you cannot control how much damage it can do to you. And that one shift in thinking changes everything. If you look at this section, there are three key ideas: control, focus, and success. Control means you accept one fact. You do not control outcomes. Focus means you stop chasing profits and start protecting capital. And success comes from consistency. Not one big win, not one perfect trade, but repeated discipline over time. So, before anything else, you need to understand this. Your first goal is not to make money, your first goal is not to lose it. And what is the expected value? And let's talk about the probability. This is where the most people think incorrectly. They look at one trade and ask, did I win or lose? But that question doesn't matter because one result means nothing. Instead, you think in averages over many trades, and that is the accepted value, expected value. So let me ask you, if you flip a coin 3 times, can you predict the result? Absolutely not. But if you flip it 1,000 times, you know what will happen. So that is how you should think about markets. And let's talk about the position and how much you risk. And this is where the most people make their biggest mistake. They don't lose because of bad ideas. They lose because they risk too much. Position sizing is simple. How much of your capital is exposed in one decision? And this controls everything because even a good strategy fails if your position is too large, but a decent strategy can survive if your position is controlled. So again, it's not about being right, it is about staying in game. And exposure versus the outcome. Here we talk about what you control and what you don't. So exposure is what you control. That's your position size and that's your risk. The outcome is what market decides. And most beginners focus on only the outcome. They try to predict and they try to guess. But experienced participants focus on exposure. They ask one question: if this goes wrong, how bad is it? If the answer is not that bad, then they can continue, and continuation is everything. Let's talk about the risk slash reward ratio. And every decision here has a loss and a gain. That's your risk to reward ratio. For example, if you risk one to make two, this changes everything because now you don't need to be right all the time. Even if you're right only half the time, you can still grow your capital. So the goal is not accuracy, the goal is efficiency. And the win rate misconception. Now, this is where the most people get trapped: the win rate. People think a high win rate means success, but slide shows something important. Profit depends on loss size. You can win 80% of the time and still lose money. Why? Because one large loss can erase many small wins. So, again, being right is not enough. Controlling losses is what matters. And then now let's talk about leverage, which increases your exposure. It allows you to control more capital than you actually have. And that sounds good because the reality is it also increases your risk. A small move against you uh, becomes a large loss. So leverage is not just a tool for growth. It is a multiplier of risk. And if you don't manage it properly, it destroys your capital very fast. And let's look at some of the drawdowns we have. This is the part most people ignore. Drawdown is the drop from your peak. And here's the key idea: the bigger the loss, the harder the recovery. If you lose 50%, you need 100% just to break even. So, avoiding large losses is more important than chasing large gains. This is why risk management exists. And lastly, we have the diversification versus concentration. How you spread your capital. Diversification spreads risk. If one decision fails, others protect you. Concentration does the opposite. It increases potential return, but also increases dependency on being right. So this is always a trade-off. Stability versus potential. And you need to decide based on your own strategy. Well, now let's bring everything together. We talked about risk management, which is not a small part of the game. It is the game where you control your exposure, where you limit your losses, and where you stay consistent. And that's what allows you to succeed. So next time you look at the trade, don't ask how much can I make, ask how much can I lose? Because that question is what separates beginners from professionals. Thank you for listening.